Greetings from Chicago. I am Don Prattle, the Director of Trader Development and Education here at TradeStation, and it gives me great pleasure to bring to our webinar series Mr. John Bollinger. And he's going to talk to us about a very specific strategy that he uses with his tools, the Bollinger Bands, as you know, and he calls it the Bollinger Band squeeze. And it occurs when volatility falls to low levels and the Bollinger Bands narrow. According to Mr. Bollinger, periods of low volatility are often followed by periods of high volatility, so a contraction or a narrowing of bands can foreshadow a significant advance or a decline. And once that squeeze play is on, a specific band break signals the start of a brand new move. Our presentation today is one of a series of the industry's top educators, and each of our live webinars is designed to show you how to maximize the power of the TradeStation platform. As you know, Mr. Bollinger is the president of Bollinger Capital Management, a firm that provides money management and proprietary technical analysis research. Remember that everything we talk about here in our webinar series is for educational purposes only. All the symbols, all the trading ideas, and everything we will be discussing are for demonstration purposes only. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everybody, and options trading carries a high degree of risk and may not be suitable for all traders. I've included in the chat panel way at the top, you may have to scroll back to get it, 2 pieces of disclosure information regarding the characteristics and risks of standardized options and the other asset classes that we make available here on the TradeStation trading platform. So having gotten all that out of the way, generally the first question out of the box is, hey, Mr. TradeStation, are you recording this event? And yes, we are recording this event just like we do almost every one of our other educational setups. And so that recording will be available tomorrow on the TradeStation University site, in the TradeStation YouTube channel, and also in the, if you are a TradeStation customer, on the Video Station app on the trading platform. Without further ado, I want to turn the microphone over to Mr. John Bollinger.
Well, hello everyone. I can't hear Don Prattle, unfortunately. Technology has failed me once again, but I assume that because this slide is up that it is time for me to start talking. So I will do so. I want to take a little bit of a different tact with today's presentation. I've taught Bollinger Bands and various forms of Bollinger Bands, various tools and techniques several times for TradeStation. I thought I'd take a little bit more of a personal approach this time and try to tell you some of the things that I think are personally important to me, a little bit of the history of how I got here, and a little bit of some of the thoughts behind Bollinger Bands and the Bollinger Band process, along with I actually will present to you an interesting Bollinger Band alternative a little bit later in the presentation. But first, I really would like to encourage you to ask questions during the presentation. I'll leave some room at the end of the presentation so that we can deal with them. I really like it when there's a give and take, and I have available here also the TradeStation platform with my squeeze software loaded into it, ready to go, so we can look at individual issues. However, if you want me to look at an individual issue, you must supply the symbol. It's just too hard for me on the fly during the presentation to look up the symbol for something. If you have a question about a specific issue or something that's going on in the marketplace, that's fine, but please do supply the symbol. So having said that, let's get right into the heart of the beast here. The resources that we use today are all available on TradeStation. All the slides were prepared on TradeStation 9.5 with the Bollinger Band squeeze package that's available in the Trading App Store. And for those of you who want to go further and dive in deeper to the process, there's also a full-blown Bollinger Band toolkit available in the Trading App Store that includes a much greater variety of Bollinger Band tools, some things that work with pattern recognition, identifying W bottoms, 3 pushes to a high, and things like that. But today we're just going to focus on the squeeze and its companion tool, the bulge. Both extremes in volatility where I think substantial opportunities to exist. I started in this business as an option trader, and it was through option trading that I discovered the ideas behind Bollinger Bands. It was very early in the era of desktop computers, and I was fortunate to have an early spreadsheet called SuperCalc. And one day I copied the formula for volatility down a column, and I saw it was changing over time. Now, that was really interesting to me because I'd been looking for a way to set the width of trading bands automatically. We'd been using trading bands for a long time before that, but we usually use percentage bands, and it was problematic because when you set the width of the bands, you would draw the band so if you were bullish, it presented a bullish picture, or if you were bearish, it presented a bearish picture. What I wanted was a way of eliminating those emotions from the process and having the width of the bands calculated by a program and then set and drawn right on the screen for me. And so that was the sort of genesis of Bollinger Bands. At the time, um, volatility wasn't considered to be a good candidate for such an application because volatility was considered to be stable. People didn't understand that volatility was not only volatile, but that it was cyclical in the sense of going from high to low. It was only in the middle 80s and such that those ideas became widely adopted. So I was thinking a lot about volatility because I was an option trader, and in order to be a successful option trader, you have to have a handle on volatility, specifically the volatility estimates that are involved in option pricing. So just a little bit more background before we dive in. There are really two forms of volatility that we're going to talk about today. There are some more, but we're going to talk about two forms specifically. The first is historical volatility. That's a mathematical measure of using a function of the price changes of the past period. We're going to look at the price changes of the past 20 days, and we're going to use the same calculation that's used for standard deviation. However, the standard rules for standard deviation, 95% of the data within plus or minus 2 standard deviations aren't going to work for two reasons. The first is our sample size is too small. And the second is that securities prices are not normally distributed. So instead of finding 95% of the data inside the bands as most people would expect, we typically find 89, 80, or 90% of the data inside the bands. It's a pretty big miss. But once you know that, then it's very easy to work with them. So on par over a long period of time, we expected to find about 5% of the closes outside of the upper band and about 5% of the closes outside of the lower band. So Bollinger Bands are a form of trading bands, and Bollinger Bands, like all trading bands, define whether prices are high or low on a relative basis. By definition, price is high at the upper band, and by definition, price is low at the lower band. Usually when I do these talks live, I make everybody stand up and repeat these lines after me. So I can't see you, so we're going to use the honor system here. we're all going to say this together simultaneously. By definition, price is high at the upper band, price is low at the lower band. I suspect that a few of you cheated, but that's okay. I just want you to really get this idea about what trading bands do and what they're for. Once you have those definitions, we can use those definitions for a lot of things. Pattern recognition is a very popular use. I'm going to talk to you a little bit about combining indicators with price action in the bands today, and we're also going to examine the width of the bands themselves quite a bit today. So here's a basic chart from TradeStation. It's Amazon, and you can see we've had quite a strong run. You see the Bollinger Bands there. The upper band is shaded red. The lower band is shaded green. And if you look at that middle band, you'll notice that it alternates between red and green. It's green when it's advancing and red when it's declining. That's because we use the middle band primarily as a trend indicator. When it's green, the trend is up, and when it's red, the trend is down. And it's colored just by the one-day rate of change of the middle band. So if the middle band today is lower than it was yesterday, the line segment connecting today and yesterday is colored red. And if today's midpoint middle band is higher than it was yesterday, then that line segment is colored green. And that gives us some sense of the overall trend. And why do we want that? Because in an uptrend, we're going to bias our operations to the long side, and in a downtrend, we're going to bias our operations to the short side. So two things here that I want you to see is that the Bollinger Bands really do define whether price is high or low on a relative basis. You can see that we swing from the upper band to the lower band quite frequently, and that often we go through extended walks up the upper band, and if we had big declines, so there's a little decline over on the left-hand side of this chart. You have a situation where price can walk down the lower band. The biggest mistake people make with trading bands and Bollinger Bands in specific is they think that when price touches the upper band, which we call a tag of the upper band, that's a sell signal, and when price touches the lower band, that's a buy signal. That's just not true, or at least to make it true, you have to bring more to the game than just price in the Bollinger Bands. I like to use volume indicators and pattern recognition and the width of the bands, amongst other things. But you just have to bring a lot more to the game. There's nothing about a tag of the upper band that's a sell signal in and of itself. And there's nothing about a tag of the lower band that's a buy signal in and of itself. And we'll get a bit more into that as we go along. So Bollinger Bands are volatility bands. There are several other kinds of volatility bands out there. Donchian bands are quite well known. They're also driven by a measure of volatility. In that case, it's range. But Bollinger Bands are driven by volatility. So when volatility is high, the bands will be quite wide, and when volatility is low, the bands will be quite tight. And you can see that on the chart here. Let me get a little. You can see that we go from the bands being very, very wide in this regime to just a little bit later, the bands are quite tight. And we're going to come back and look at this pattern right here again a little bit later. But I just want you to see how variable the bands are over time, from very, very, very narrow to quite wide indeed. So the calculation we use for volatility is the calculation that's used for standard deviation. And we use this for a very specific purpose. Inside that calculation is a little bit of math that really helps the bands function. what standard deviation does is it measures the distance of the closes from an average, and then it takes those distances and calculates standard deviation. But if you were just to take all the distances of the average of the closest from the average and sum them together, it would come to 0. So in order to get over that, to get over that problem, mathematicians square those numbers, and then they sum the squares, and then they take the square root, and that gives them their estimate of volatility. It's the squaring process that's so important. If you square a small number like 1, you get another small number like 1. But if you square a larger number like 10, you get a big number like 100. And if you square a big number like, 100, you get a giant number like 10,000. So it's very important, that internal measure, because it keeps our definition of prices being high or low germane to the price structure. If we've been in a consolidation, all of a sudden price starts gapping away to the upside. The bands capture those price gaps through the standard deviation calculation and spread very quickly to keep our definition of high or low germane to the price structure. So what I like to say is that we use the calculation for the standard deviation, but not the rules of standard deviation. And again, that's because of those two problems, generally a small sample size and the prices not being normally distributed. So the defaults for Bollinger Bands are daily data, 20 periods is the length of the calculation, both for standard deviation and for the middle band, and plus or minus two standard deviations. On this slide, I have also included what I call practical ranges. So for 20 periods, the practical range is really from about 10 to 50 periods. If you want to get longer than 50 periods, I suggest you move from like dailies to weeklies or from hourlies to dailies. You put more time in each bar rather than get much longer, because the bands stop being responsive when the calculation number gets too high. And on the short side, if you get the calculation down toward 10, actually the bands start to get very volatile and such. So I'd suggest shortening the amount of time in the bars rather than going down below 10 or so. The practical range for the type of data we use is very wide ranging. I was raised using daily data, so that's my favorite, but Bollinger Bands can be used on hour charts, 5-minute charts, minute charts, weekly charts, monthly charts. It works the same ideas. The ideas work all the same. There's virtually no difference in application. The only practical limit is that on the short side, if you get down to very, very short time frames, you have to have enough price activity in each bar to see the price formation mechanism at work. That's really important. If you get just a few ticks inside of each bar, the bars are going to look chunky, and you're going to get multiple closes at the same price. Price might rattle back and forth between the high and low, and that's just not good for calculating trading bands. So the practical limit in the short term for a stock like Google or Amazon or something like that is probably very, very short-term bars indeed, because there's so much activity, so much trading activity. But for a small cap stock that doesn't trade much, you might not be able to even get down to hour bars and still have enough activity inside each bar to see the price formation mechanism at work. And as far as the width of the bands, I stick with 2 standard deviations, plus and minus, most of the time, but some people like to get as tight as 1 standard deviation or as wide as 3. And even more interesting, some people like to plot multiple Bollinger Bands on the chart at the same time. So they'll plot bands of 1, 2, and 3 standard deviations, and then create a rule set to work with those. But for me, 2 standard deviations is the basic idea. So today we're going to talk about 2 indicators that are created from Bollinger Bands. These were in fact the first 2 indicators that I created from the bands. And interestingly enough, these indicators will work with any type of trading bands. I use them for Bollinger Bands, but you can use them for Keltner bands or Stark channels or Donchian. It's all the same. So %B tells us where we are in relation to the Bollinger Bands, and bandwidth tells us how wide the Bollinger Bands are. So %B was derived directly from the formula for stochastics. I just substituted the upper band for the periodic high and the lower band for the periodic low in the stochastic calculation. So just plugging those values into the calculation, we get 1 when price is at the upper band, 0.5 when price is at the middle band, and 0 when price is at the lower band. The price will be a value less than 0 if price is below the, I'm sorry, %B will be a value less than 0 if price is below the lower band, and it will be a value greater than 1 if price is above the upper band. So %B has many uses. I use it a lot in pattern matching and system trading. I've given numerous seminars showing how to use %B to diagnose W bottoms, and our version of 3 pushes to a high pattern that we find often at tops in the marketplace. There are many other applications for %B, but there's just a sampling of what it can be used for. And here's that same chart of Amazon, but now we have a chart of %B in the clip beneath it. You can see when price gets above the upper band, %B rises above that red line, which is a value of 1, and when price gets below the lower band, which is to say price gets oversold, then we have a value below that green line, and that's a negative value for %B. I'm not going to go into all the pattern matching and pattern ideas here. Today, I just want you to have a basic understanding of %B, and when we start looking at some of the squeeze patterns, you'll see an application of it. But you really need to understand it before we get there. So bandwidth is the second indicator that I'm going to teach you today. It is simply the width of the bands, the distance from the upper Bollinger Band to the lower Bollinger Band. So Bollinger Bands we know already driven by standard deviation. So bandwidth tells us how wide the Bollinger Bands are. It can be compared across time, and less importantly, can be compared from issue to issue. The most important application certainly is comparing it across time. That's what we're going to look at today, and I think the most important idea. So the formula for bandwidth is simply the distance from the upper band to the lower band. We divide by the middle band to normalize, so and you know, the typical values will be from 4 or 5% on the low side up to about 50% on the high side. It's certain market extremes. 1 second. I'm sorry, there's a small dog yapping outside the window and making it very hard to concentrate. So I sent somebody to see if it can't be comforted. So the useful range here is about 5% up to about 50% or so. Occasionally you'll get extremes out of that, but I think you're going to find most of the readings here in the 7 to 20% range. And of course that varies a lot from stock to stock. And here's a picture of bandwidth, and you can see just how dramatically it changes over time. Again, this is Amazon, and you can see the huge range that bandwidth traverses. That's the magic of Bollinger Bands. That's that calculation for standard deviation working full time for you. It's it keeps that definition of high and low germane to the price structure. And so the peaks in bandwidth up there when it's touching that upper red line, we call bulges, and the troughs in bandwidth when it's down there touching that lower green line, we call squeezes. So there are 3 squeezes on here, and let's see, 1, 2, 3, 4, 5 bulges. And we're going to talk about those in some more depth as we go along. So this is what my basic Bollinger Band chart looks like. This is sort of my default chart. A little bit later you'll see I will add a volume indicator at the bottom of this chart. That indicator is going to be intraday intensity. It's also part of the squeeze package. And it gives you a good sense of supply and demand, and it also is a pretty good trend indicator, and I'll talk a little bit about that as well. So volatility, when trading Bollinger Bands, in a sense you're trading volatility. You may not be trading it directly, but your analytics are derived from volatility, so there's volatility involved in your decision making. And as such, options are a natural vehicle for some Bollinger Band trades. I'll delve into this more later, but when I first started out, I developed the bands as an option trading tool, and so I have a lot of familiarity with the use of options in Bollinger Bands and the way that option pricing interacts with volatility. So Bollinger Bands are created with historical volatility. We go back and measure the standard deviation, or use the calculation for standard deviation to measure volatility for the past 20 days to find the bandwidth for each bar. That is a quantitative factor. It is a fact. If you calculate it 100 times, it will always come out the same. There's no emotion in that fact. It is simply a black and white fact. But Bollinger Bands can also be created with implied volatility. And implied volatility is a psychological factor. It is the estimate on average that traders use in pricing options given their outlook for the market and their outlook for that stock. So the historical volatility bands, which are the ones that most everybody uses, the quantitative bands using historical volatility are based on fact, literally derived from the price structure. But if you were to calculate Bollinger Bands using implied volatility instead of historical volatility, you'd have quite a different beast on your hands. You'd have psychological bands, and those two, you can actually plot both types of bands on the chart over time, and you'll see that the psychological bands will swing inside and outside the quantitative bands, creating a sentiment indicator that's actually quite powerful. So volatility is still very poorly understood, even having gotten a couple of Nobel Prizes and having been studied extensively since 1982. We've got 36 years worth of academic work on volatility, and about somewhat less than that, maybe 25 years of Wall Street analytics based on volatility and such. And then in the options world, again, another long stream of studying volatility. But yet, volatility is still pretty dramatically misunderstood. And the reason for that's pretty simple. It's the way it's taught. Volatility is taught as following the elemental laws of statistics, including mean reversion. But in fact, volatility is not mean reverting, as it is almost universally believed to be. It is extreme seeking. That is, low volatility is a forecast for high volatility, not normal volatility. And high volatility is a forecast for low volatility. Again, not normal volatility. So once you understand that, you actually can get pretty far ahead of the game. So a squeeze is a trough in bandwidth. It's a period of low volatility, and it's a forecast for increased volatility. A bulge is a peak in bandwidth, and it's a forecast for decreased volatility. But there's another way of thinking about that, and that's this. The squeeze is the beginning of something, and the bulge is the end of something. So another way of saying this is a squeeze is where trends are born, and a bulge is where trends go to die. And these are very important concepts that once you get your hands around them, will improve your trading pretty dramatically. So here we have a bulge. You can see that the big spike in volatility right here, and the downturn. The downturn is what actually makes it a bulge. If you note here, you see this red line. So that was the level that was necessary for for it to qualify as a bulge. And you can see that was hit over here, and volatility just kept on rising, pushing that red line up. We don't actually have a bulge until we turn down from that red line. That's the definition of a bulge. The bulge is when you actually turn down, because as you see, when volatility is on the rise, you have no idea how high it's going to go. And so even though it's maybe the highest volatility that you've seen in 6 months or a year or maybe forever, you still have no idea how high it's going to go. So once we say that once volatility is at a 6-month high or 125 period high, it qualifies to be a bulge, but it's not a bulge until volatility turns down. That's when we actually get a bulge. Now, if you I've highlighted that area in the yellow rectangle. If you look over at the right-hand side of the rectangle, look down all the way at the bottom, and you can see right after the bulge, prices consolidated for a period of a bit more than a month, and volatility dropped all the way to squeeze levels. And then immediately the trend started up again. So there's two things on that slide that I want you to see. First of all is that in this case, the transition from the bulge to a squeeze was a transition from an uptrend through a consolidation to the resumption of an uptrend. But you see that red arrow there pointing toward that green bar? That green bar is what we call a head fake. And so we had a squeeze, we broke strongly to the downside, and then immediately reversed hard up back into the bands. That's called a head fake to the upside. And it's that squeeze and head fake that usher in this uptrend that we see over here. So a bulge here marking the end of the trend, a squeeze here marking the beginning of a new trend, a possible beginning of a new trend, and then the head fake itself actually signaling the beginning of the uptrend. If I stopped right here and said, I'm tired, I don't feel like doing the rest of this seminar today, let's go have a nice walk. It's a beautiful day here in California and such. If you just took the little bit that I told you and took that to heart and thought about it for a long time, you'd be so far ahead of the game that it would have been worth coming to the seminar, even if you had to pay $1,000 to attend it. So just sort of remember this slide and remember these concepts. They're just they're just invaluable in your day-to-day operations. So a couple of bulges here. The arrow on the left, this guy here marks a bulge, marks the end of this uptrend. You get the downturn here, and then immediately you get another bulge, and the downturn in the bulge marks the end of the pullback. So that's what bulges are all about. Bulges are about the end of trends. As I showed you on the previous slide, it doesn't necessarily mean a price reversal. It could become a consolidation. It just means that the odds favor that the trend that has been in place that created the bulge is at an end. And then over here we have a squeeze that leads to a downtrend. So I think that's about all on that slide. So a squeeze or a bulge, how do we find a squeeze or a bulge? I hinted at it before. A squeeze is 125 period low in bandwidth, and a bulge is 125 period peak in bandwidth. Doesn't matter at all whether the bars are 5-minute bars or 10-minute bars or hour bars or daily bars, weekly bars, monthly bars, yearly bars. It's all the same. 125 periods. I understand that it would be quite the item to have 125-year squeeze, but I don't think too many of us trade yearly bars. So it's 125 periods. And the interesting bit is that 125 is an extremely robust number. It is. It could be 100. It could be 150. It doesn't. It's very insensitive to changes in its values, and that's what we call a robust system. So here's the basic the basic page from the Bollinger Band squeeze package, and I'm going to just go through the columns here. That column that's the list is of the stocks that are in the OEX. It's just 100 stocks, and it's about the middle of the alphabet, as I recall. That first column is called mode, and that tells you what stocks are in squeezes. There's about 10 of them. If you look down toward the bottom of the screen, there's one stock that's in a bulge. Then look over at the right-hand side of the screen. Here's our chart, and here's percent B, and here's bandwidth. And then here's that indicator I was telling you about. This is an accumulation distribution or a supply-demand sort of indicator. It was developed by David Bastian. It's called intraday intensity. I like to plot it at the bottom of all my charts. And you can see during this entire period here, basically intraday intensity has been quite positive with only a couple of down days, indicating that there was strong accumulation and the uptrend was pretty intact. Here we have a giant squeeze. You can see it down here, and then these arrows are the long entry signals based on the squeeze. Have another squeeze over here, and these arrows are the long entry signals based on this squeeze whatsoever. So here's these red dots here. The green dots here are the squeeze indicators. The red dots are a bulge indicator, and these smaller red arrows and smaller green arrows, those are what we call back in. So that means price was able to close outside of the lower band and the next period closed back in. That would get you a green arrow like this one, or in this case over here, price closed above the upper band and the next period closed back in the Bollinger Band. Those I use for two things. They're alerts that cause me to look at the chart and see what's happening, focus and see if I need to be making any decisions. And secondly, immediately after a squeeze, a back-in signal is a signal of a possible head fake. So we'll talk about that a little bit more. So the second column here is tells us whether we've had a signal within the past 5 days or not. You can see on that chart we've had 5 short signals or 5 sell signals and 1 buy signal. 3 of the short signals have a -1 after the short, meaning that the signal occurred 1 day ago. So it didn't occur today, it occurred yesterday. And then the third column are the green flags tell you whether you've had a back in to the upside signal, and the red columns, the red flags tell you that you had a back in to the downside signal. So with just a simple scan here, you can come and find a bunch of trading opportunities to pull up on the screen next door. If you click on any of those, on any of these symbols here, they will immediately cause this chart to draw itself with the contents of that symbol, so that you can then, I view this sort of as a research list. I click on all those through and find the ones that I actually want to trade, the ones that are setting up properly, and um, that I want to explore further. So here's that squeeze we talked about. I just want to emphasize how that works. You look, you can see these green dots. I can blow this up for you later if you want to take a look. You can see these green dots. Each of these days means that we've qualified for a squeeze these days, and these green arrows means that we've broken out. We've had a squeeze and a breakout. So all of this, everything in this package is customizable. I just put this screen up so that you could see what all the parts and pieces, the components are. You can just come in here and you can change any of these values that you want to tailor this screening and finding process to exactly what you like. I personally leave it set at the defaults most of the time, unless I have some specific mission in purpose, but the package is highly flexible if you want to tailor it to your use. So here's an example. This is actually from a little while ago, but I really like this because people are always asking me, okay, it's a squeeze. How do I know whether it's going to be to the upside or to the downside? And there's a lot of ways. You can look at the patterns in %B. You can look at the values of uh, intraday intensity. You can do some pattern matching. You can. There's any number of ways that you can get an edge, but this one is my favorite. Um, I love when you've had a squeeze and you break to the downside sharp and then immediately reverse hard to the upside. The head fake, that is my favorite trade. I think it's the trade with the best probability, and you have a nice situation in that if you make a new low, you're wrong, so you're risking a relatively small amount compared to the potential gain, and that to me is a key importance. So here's a squeeze that leads to a big downturn. I like to point out that that these things go both ways. A lot of people only focus on the long trades, but the sell signals are equally important here. And I'm not very good at drawing here, but I'm going to give this a shot anyway. You, uh, let's see if we can't get rid of that. My point is that you have a long downtrend here in intraday intensity as the market tries to top. Momentum's dying off here, and the market's trying to top, and you have this long downtrend in intraday intensity, which should be really concerning and an alert that the break's likely going to be to the downside. And here's just another slide, a bulge marking the end of a downtrend. In this case, it was a very strong downtrend. And in this case, it leads to an immediate uptrend, but that is not actually the purpose of the bulge. My point here is that it marks the end of the bear market that was going on before in here. Let me get my bouncing red dot back. Here's the euro. It's just a lovely setup. It's one of these things, you have good accumulation going on in here. You come into the squeeze. You get an immediate break to the downside and then right back into the band. So it's a squeeze with a small head fake amidst a background of consolidation. You can see it leads to a very nice trip to the upside. One of the things that I really want you to think about is that squeezes especially often occur at logical places. And that's what you see here. You see a squeeze occurring at a logical place. This is a concept that was talked about a lot in the old history books, the old technical analysis books, but people have really forgotten it. What you'll see very often, I'm sure some of you are familiar with the chart pattern, a cup and handle, where you make a high in the market and then you get a pullback that leads to a sort of cup-shaped formation, and you get a little consolidation after the cup that they call the handle. So that handle will often be a squeeze, and that squeeze is occurring at a logical place. It's occurring at the immediately prior high, the left-hand side of the cup. And that's actually the best example I can think of a logical place. It's just a concept that you should keep in the back of your mind. So option trading, this is how I got in. This is how I discovered Bollinger Bands, and so these are just some thoughts to think about. Bulges are times when option premiums are very high because volatility is high and people are scared often. And so options are often very pricey in an environment like that, and professionals are looking to sell premium. So bulges are sort of time when you can look at options and see if you can discover overpriced options that look like they might be candidates for option strategies that are aimed at harvesting premium. Squeezes are exactly the opposite. Squeezes happen at times when option premiums are low, often very low. And buying options is an attractive strategy when during squeezes in the market, especially if they've gone on for a little while and the market's gotten really complacent in terms of option pricing. So to just a couple of strategies that you might want to think about. A logical thing to look at in a bulge is after a big advance, when you get a bulge in a downturn, is selling a covered call. Option premiums are often going to be pricey, and even if you just get a consolidation, it's likely that the premium will wither over the next period, and you'll be able to buy that covered call back at a lower price. Another logical thing to look at when you have a squeeze is the purchase of a straddle or a strangle. Option premiums are very low, and straddles, especially strangles, can be very cheap in such an environment. One of the things that you can do, especially if you have no idea which way the volatility is going to break, then the straddle or strangle can be very useful. And once it gets going, you just cover the opposite side of the trade and end up with a long option position favoring the direction of the emerging trend. So I used a Monte Carlo simulation to find attractive opportunities. For many years, I actually ran an option service called OptionTrader.com, and we put up the results of Monte Carlo simulations of stocks that were in squeezes. And what we did is we calculated the implied volatility for the stock, and then bought a straddle, and then ran a Monte Carlo simulation to see how many of the paths would cross the break-even price for the straddle. And if we got 90% of the paths, the Monte Carlo paths, crossing the break-even levels for the straddle, but either to the upside or to the downside, then we would recommend that as a trade. So given today's software, R and SciPy and all these other softwares, this stuff is this sort of thing you can easily do at home today. So rather than say, like in those adventure shows, they say, do not try this at home. I urge you to try this at home. I urge you to try Monte Carlo simulation as a way of determining where the attractive positions are when you get squeezes. So that's the end of my prepared material. I've actually run a little bit over time. I'm still going to stay around for some questions, but if you send an email to rules@bollingerbands.com, I'll send you back a little document with 22 Bollinger Band trading rules. I think you'll find some of them quite useful. And each week I prepare a U.S. stock market timing chart pack. It's available for free and currently consists of about 25 classic market timing charts. And it's posted either Saturday or Sunday each week on bollingerbands.com. The link for both the chart package and the document describing, support document down toward the bottom of the page. The charts don't have any commentary. I present the commentary in my newsletter, the Bollinger Bands letter, which you can get at the same site. But if you just want to see the market chiming chart pack, you can pick it up each week for free at that location. And then finally, here's some contact information for us. My website is bollingerbands.com, as you might imagine. And we have a partner in Italy who's created a Bollinger Band website that presents Bollinger Band analytics for a wide variety of markets, including American markets and European markets. You can go visit them and get a free trial there at bollingerbands.us. And then if you have any questions or you want to reach out regarding something about Bollinger Bands or this talk, you can always send me email at bbands@bollingerbands.com. And with that, that's an end of my prepared talk. Let's see if we can't answer some of these questions. Does intraday intensity indicator work on Forex currencies as the volume data is not really a volume on Forex? So intraday intensity can work on Forex. Sometimes your provider will provide volume information for their platform. So you can see if it will work. The calculations differ from platform to platform, so it's an iffy prospect. You just have to go and take a look and see whether it works on the platform. There really is no central reporting for volume on Forex. If there were, I think intraday intensity would be a fantastic tool, but the results are going to vary depending on your data venue. Let's see, John, could you? These things go by so fast. Let's see, if I put a check mark on it, maybe it'll stop. John, could you explain, for example, if price is going up, candle break mid BB and close above, and mid BB is facing down? In mid-beat, does that mean something? Lindo, I sort of understand what you're saying. If if you've been in an uptrend and the middle band is turned down and price is weak enough to get underneath it, what I would do is rather than checking the price action around the middle band, I would check an indicator like intraday intensity or accumulation distribution to see if you still have strong accumulation going on. So that's a way of sifting out whether it's just been a price correction or whether you've actually seen a trend change. That trying to interpret price action around the middle band can be helpful, but it's not as clear as you you would often like it to be. I think it involves a little bit more guesswork, a little bit more emotion, whereas the volume indicators might be a little bit more useful. I notice that we have a lot of people here from Turkey today, and one of them is pointing out that I was in Turkey a couple years back teaching Bollinger Bands, and interestingly enough, my Twitter feed, if you want to check in on my Twitter feed, I am at, let's see, somehow I'm not able to, yeah, it's not letting me type in the box anymore. I don't know why. Maybe it doesn't think I'm a presenter anymore. Anyway, I am at BBANDS on Twitter. And both B's are capitalized. Maybe somebody could type that in that box for me. It's there you go, at BBands on Twitter. You can come and hang out. I talk quite a lot about the cryptocurrencies there. What can you say hold on. Oh, they go so fast. What can you say guidance regarding the typical duration of a squeeze? Oh, that's a great question, Mark S. I want a squeeze to go now. Some squeezes go on forever. And that's sort of okay. I'm going to switch over to screen sharing. Can you guys see my TradeStation screen now? Okay, so like here's a very long squeeze, right? It goes on for a very long time and it works out, it leads to a nice uptrend. But the squeezes that I like are the short squeezes. The ones that, you come, you squeeze and you go immediately. Maybe 2, 3, 4 periods in a squeeze, that's all. The longer ones are they're just frustrating for me. I look at them, I come back the next day, I look at them, I come back the next day, I look at them, and I just get bored. I want a squeeze to come in and I want immediate action. So those are the ones I focus on. And I found that head fakes, which are what I most like to trade, most often occur in squeezes that are quick. Usually don't get one after a prolonged squeeze. So and then Ananda, I guess Ananda asks, trading Bitcoin with BBs, and does that differ from trading stocks? Only to the extent that it's actually easier to trade Bitcoin and the cryptocurrencies with Bollinger Bands than it is stocks. There's less arbitrage and there's less noise in the markets. So they're just easier. I think as Bitcoin grows older and more futures trading and more options trading and as more arbitrage occurs, it'll become more and more like trading stocks. But right now, it's actually the whole cryptocurrency world is just easier with all of technical analysis, not just Bollinger Bands in general. So, and that goes for the Bitcoin futures and all the rest of it. So Peter, I'll just say Peter, say BB and log scale makes sense. Yes, absolutely, except for very low priced items where or in times of very high volatility where the lower band gets driven below zero, and then the log scaling will break. But as long as the lower band's not getting driven towards zero or worse yet below zero, log scaling is not only makes sense, but I highly recommend it. Raleigh V asks, are there any sources that you recommend for playing with Monte Carlo simulation? The R language has a very powerful Monte Carlo simulator in it that's pretty easy to use. It's part of the package is called, let's see if I can type again. It's called QuantStrat. No, it's not letting me type again. So it's QuantStrat, QuantStrat. And if you like Python, you're happy in the Python world, which is my favorite platform for this sort of work, SciPy. The SciPy package has everything that you need to do Monte Carlo simulations in um, in Python. So, and again, the idea is very simple. You can do most of it in a spreadsheet. You just look for a squeeze, and then you check the implied volatility for the stock. Using that, you figure out how much it'll cost to purchase a straddle. Let's say the stock's 25, and it costs you 4.25 to buy the straddle. So then the upper break even is 29.5, and the lower break even is 20.5. And use the 30-day horizon, so 21 trading days or so, and just run a bootstrapped Monte Carlo simulation and see how many of the paths cross either that upper boundary or the lower boundary. And if it's up near 90%, it's a pretty good candidate for you to look at. More questions. MU. Oh, you guys can you all see my can you all see my screen? So I wanted to show you one thing here. So see this see this all? This is one of my favorite setups. It's a squeeze. There was a short signal one day ago, and you got a backup signal today. That's a head fake, and there it is on the chart right there. This one's in a pretty good downtrend, so I'm not sure that I would play it. But this, where you get this, where you get to squeeze and short and a back up, or a squeeze and a long and a back down. Let's see if we can find one. I don't think you will. The market hasn't been in that sort of mode. So, but it would be like this: if it was squeeze and long, and then you got to back down here, or a long -1, and you got to back down. That's a head fake going back into the downside. These where you get these three line up like this, that's one of my favorite uses of this software. Somebody asked for MU. Let's see, I need to be over here in this one. Well, I don't have anything currently to say about it. You did get a squeeze and a breakdown, but it's ratcheted back in. Um, that's not the most comfortable pattern in the world. It is a head fake. I mean, you could be long here with a stop underneath underneath this day, but it's not the most gorgeous pattern I've ever seen. Mohammed A asks how a squeeze mode is defined. It's 125 period low in bandwidth. Can you define the column back in? Yeah, the column back in has two modes. Back in from going up means you closed outside the lower band and now have back inside, have a close inside the band. And the other one is the back in down. Um, that's you closed above the upper band and now have a close inside the upper band. So it's a 2-day reversal at the upper band or a 2-day reversal at the lower band. Lindo asks, how can I get that type of bands with the middle BB changing colors? Um, you can get it from my TradeStation packages. Um, there's a request for SPY. Of course, there would be a request for SPY, the most popularly traded security in the universe. Um, Well, I like this little reversal at the lower band here. I think that that's actually pretty constructive. And I'm pretty constructive on the market as a whole. If you take a look at my market timing chart package, which you can get on BollingerBands.com, um, you'll see that the internal structure of the market's still quite good. There's virtually very little deterioration. So I might take this little pattern here at the lower band, this little 2-day reversal here at the lower band, as a positive indication. Is everybody asking for why? Are they answering yes to a question? Is there somebody must have the symbol Y? Let's take a look at that. There you go. So this is that sort of thing that we talked about before. This is a long squeeze here, the sort that just, you get a long squeeze and then you just don't get much out of it and then sags back in. It'll probably squeeze again here. That's why I don't like these squeezes that go on for a long time. I like the ones that happen very quickly and ratchet right along. Does anybody know a symbol for Bitcoin on the TradeStation platform? I'll do QCOM while somebody comes up with that symbol. I used to know the symbol for everything, but as the years have gone by, too many symbols changed. There was too much. There was too much. So this pattern looks pretty negative to me. I'd say we can continue to see some weakness in this for at least a few more days. It's not giant negative bearish, but just I don't see any indication that there's a turnaround on hand in QCOM right here. So I don't think this is I'm using a special account for this seminar. So I don't think that I have futures enabled here, but I'll try it. At Bitcoin M18. So let's try it at BTC M18. Those are the June futures. Yeah, there you go. Not much history, but there you go. Um, pretty well confirmed downtrend here. Tried several times to stop the downtrend, but hasn't been able to do so yet. Accumulation distribution quite negative here. Look down there on the bottom. Maybe that at BT the continuation contract will work as well. Get a little bit more history. Nah. Well, it works, but it doesn't have any more history than. Oh, at BTC is just the front month, right? What's the continuation? Um, what's the continuation contract? Somebody must know that. Yeah. Oh, yeah. But they point out it's such a new future. The continuation contract won't make any sense. That's right. Okay. Okay. There you go. I'm going to go back, way back in the scroll back here and see some questions from earlier that I missed because I wasn't looking at the questions. I wasn't looking at the questions during my talk. I get distracted easily, so I can't do that. A lot of people asking about the recording. TradeStation is definitely going to record this and make it available. Somewhere's in the scroll back is a link for that. You contact your TradeStation rep and well, I think we're into an hour and 15 minutes for what was supposed to be a 45-minute seminar. So I think what I'm going to do is I'm going to say goodnight. I really enjoyed. I really enjoyed spending some time with you today. I hope see you on Twitter or on my website or in the email, etc. I'm sorry I haven't been able to hear Don. Technical glitch. If I talked over him, I apologize. I really wish you the very best. Good trading and all the best in life.
Thank you, Mr. Bollinger, for your time with us today. Without a doubt, the squeeze is one of the most talked about of your Bollinger Band strategies, and so we were very happy to have you lay this out for us today.